All financial advice provided on this show is for entertainment and educational purposes only. The financial ideas and strategies discussed are only provided as a starting point for a conversation about money matters. With regard to your particular investments and financial strategies, consult your financial planner, CPA, or investment professional. All your financial decisions are yours and yours alone to make, and subsequently are solely your responsibility. The information that is supplied through the context of the radio program and any repurposing of its content by the host or network is a combination and collection of solid financial investment understanding, opinion, and comments. This network, show, and its host are not liable for financial strategies, outcomes that you employ in any manner that result in any kind of loss. Shares of corporate sponsors may be the subject of buy or sell recommendations in Jay Taylor's newsletter in accordance with Jay's objective opinion.
Welcome to Turning Hard Times into Good Times with your host, Jay Taylor. This hour will help investors fix issues and achieve personal gain. Now, here's your host, Jay Taylor.
Well, welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm speaking to you here from New York on the 21st day of February 2017. I'd like to remind you each week I'm also the author of a newsletter, Jay Taylor's Gold, Energy, and Tech Stocks. And you can subscribe to that by going to miningstocks.com. Also like to encourage you to consider signing up for Chen Lin's letter, What is Chen Buying, What is Chen Selling? He's had a stellar track record. You might want to go to chenpicks.com to sign up for Chen's letter. Thank you to each of you for listening to this show, making it one of the more popular shows on the Voice America Business Channel. And encourage you to continue sending along your questions and comments, criticisms, and praises to questionsfortaylor@gmail.com. And we do want to thank our sponsors for making this show economically viable. Without them, we would not be talking to you each and every week. Sponsors for today's show, Dynacert Inc., Golden Predator, Chilean Metals, Arvista Gold Corp., Novo Resources, Uranium Energy Corp., and Aran Resources. Last week, Doug Casey was scheduled to be my guest, but unbeknownst to me, some couple hours before showtime, Doug sent a message regretting the fact that he would not be able to be with me. So as it turns out, we didn't have a guest, and I had to wing it. I was ill-prepared, did the best I could, but the good news is that Doug will be scheduled to be on my show on March 7th. So March 7th, at the time that I'm at the Prospector and Developers Conference in Toronto, I'll be pre-recording that entire show, but Doug is scheduled to be with me for that show. I've titled today's show, Are Stocks in Their Terminal Melt-Up Phase? Peter Grandich, Amir Adnani, and Michael Oliver return as guests, and Peter Grandich, former known as the former Wall Street whiz kid, returns to tell us why he thinks that the U.S. equity markets are in a terminal melt-up stage. And he will also share his thoughts on what you should do to protect yourself against the carnage of the next major bear market. Perhaps the worst performing commodity over the past couple of years has been uranium. But I'll be speaking with Michael Oliver just in a couple of seconds here, just to ask him what his thoughts are. And it seems as though, looking at a chart that he sent out to his subscribers over the weekend, it looks like there may be some reasons for optimism with respect to uranium. And that would certainly be good news for Amir Adnani, the CEO of Uranium Energy Corporation. Amir will be with me at about 1:30 to talk about uranium energy and what their plans are if and when we see a breakthrough in the uranium price. But now we are fortunate once again to have Michael Oliver with us. Thanks for joining me again, Michael.
Glad to be here, Jay.
Always good to have you here, and it's olivermsa.com. I always want to get that in there because olivermsa.com is where you can go to sign up for Michael's letter and to learn about his service. Last weekend, Michael, as I was just noting, you put out a chart on uranium, and I think now looking at it, certainly from a momentum point of view, the weekly momentum chart that you put out looks pretty bullish. What can you tell us about uranium now, and what are your thoughts about that metal?
Well, it's of course it's an illiquid futures contract, but it does reflect the real world of uranium prices. And you're right, it collapsed more than any commodity over the last several years. And I ran two studies of it. One was a 50-week average momentum study, which is like a one-year average almost, and that broke out some months ago and had a good percent rally up to 26.5. I think it's trading at 25 right now. But when I ran annual momentum using a 3-year average, 36-month average, a longer-term momentum study, it said, no, you're probably in a basing pattern. You've probably seen the low, in fact. But the major breakout level is adjust down about every month with the decline of the 36-month average. It's up above 31 right now to break out. And we're at 25. So there's a way to go. It's $6 or so. But that average comes down every month. And any month we can clear that average is a breakout. And the reason it's a breakout is in 2015, you spent the entire year butting up against the average, trying to get above it, and couldn't do it. So it was structural resistance. Well, if that you can get above that average now, and it's coming down, the average is coming down, like one of those leaning buses,
Yeah.
Okay.
Right.
Then you've got a breakout, and at that point, I would declare uranium's a major bull market. I suspect it's going to happen. Just by looking at the charts, we're not there yet, and to be 100% sure that it's going to happen, I want to see that average crossed. I suspect sometime later this year, uranium's going to break out and become a bull again. And I think you've probably seen the low in it. And probably the best way to participate in that kind of thing is not in the commodity itself, but in the producers of it. And I didn't offer any specifics on that, but one of your guests is likely to provide an answer to that.
Well, yeah, Amir, we're going to be speaking to Amir Adnani, the chairman of Uranium Energy Corporation, and I know he's looking at something like a $40 price to go back into production. He's one of the lower cost producers in the industry, but he needs to see something like that to make economic sense to put his capital back to work. But in any event, that's very encouraging, I think, Michael. So we might see one of those whoosh moments if we get through that long-term moving.
I think so. I think it's a later in the year issue. A couple quarters maybe, but I suspect this year uranium will shift the balance and will turn into a momentum bull at that point. And by the way, even buying uranium in the low 30s, let's say, is very cheap. It was in the 80s before, back I think 2011 or so. So we're still dealing with low prices. So even though if you wait till the low 30s, it's not like you're reaching high.
Yeah, exactly. Well, very good point. Very good point. Well, so we might see uranium might be one of the better performing energy sectors this year, you reckon, huh?
I think so. I think oil's probably got another spike in it. I think we're probably in that attempted spike right now, but I don't trust it much beyond, let's say, the upper 50s if it got there. So far, the high of the year has been above 55. We're in the 54s right now. I'm looking for oil to not be a commodity leader this year. I think the grains will likely overcome it. Yes.
All right, but your big emphasis, as I take it from the weekend, is the S&P 500. You're very concerned that we're in a melt-up phase, possibly. We talked about this a little bit last week when you compared the S&P chart to the pinnacle of the Chrysler Building in New York. A very interesting comparison there. I
think that picture holds up. I think we're in a spike. By the way, the S&P historically, if you go back to the last few major tops, 2007 was a wide distributive top. Many months been up there in the mid to high 1500s. The 2000 top was a wide, 1 year wide distribution top, no spikes. Okay, it's rare. You have to go back to 87. In fact, I was fortunate enough to catch that crash, and it has the same attributes now that we did then. Namely, you're spiking to the upside. You're not getting a distributive top, a sideways top. You're getting a runaway. What happens is you transition into the next quarter. Back then, it was in August. You peaked, August of 87. You slumped off into September, the final month of the quarter. By the time you opened October of 87, the three-quarter moving average had come up. And the problem with that was that you were in close proximity to touching it. You couldn't because you'd already used it twice in the prior year as support. So coming back a third time is like, leaning against a plywood door. You bump it once or twice, and the third time you go through. Well, we have the same pattern now in momentum. You have two times the Brexit vote. Remember, the market sold off in late June. And again, the Trump election, there was a sell-off prior to the explosion that took you down close to the three-quarter average, just like the Brexit vote did. Neither one of them touched the three-quarter moving average. Starting in April, three-quarter average is now projected to jump above 2220. That's 5.9% below the current market. Therefore, if between now and then you get a, quote, buying opportunity that gets you back down to 2220 area, the market's in trouble. So if this, in fact, is an exhaustive spike and it has those attributes, you can't sneeze. If you sneeze, it's going to come apart. And because of the upside spike behavior, I tend to think the downside will be rapid if triggered, instead of like a distributive top where your downside is more layered.
Yes. So it could be so really very dangerous then, potentially.
Sudden up brings sudden down. Yeah, it's equal and opposite. Yes.
All right, Michael, with 2 minutes left here yet, I have to also ask you to comment. You raised the rhetorical question. You said, how come intermediate trend of momentum for gold, euros, the euro, and the T-bonds have shifted to positive? Well, do you have a theory or two as to, might explain why gold?
I'm not sure on that. They've been contrary to the S&P, and when I say intermediate momentum, I'm measuring these markets against their 10-week moving average, for example. It's not some real long-term thing. But all three of those markets, T-bonds, gold, and the euro, have been contrary to the intermediate trend of the S&P. And the three of the gold especially, but it's evident even on the euro, even though it's backed off in the last few days, and same with the bonds, they have turned a corner on intermediate momentum back to positive. Now, given that they are inverse to the S&P, I have to think that if those turns are valid, even if sluggish, then it should be that the S&P has an intermediate downturn soon. And like I said before, you can't afford an intermediate downturn in the S&P, one that produces 5 or 6% of, quote, correction, because if it does, it's going to snowball into something larger. So I find it very interesting those three inverse markets to the S&P have turned positive on the intermediate trend, which makes me think the S&P might be ready for an intermediate downturn.
Yeah, very interesting. Well, one of the things I do like about your work, in addition to its accuracy, is the interrelationships that you're always paying attention to between markets. And I know that from a fundamental point of view, you understand markets as well as any free market practitioner I know, but at the same time, you don't allow your own ideas to get in the way of what the market is collectively, the collective wisdom of the market, I should say. And I think that's one of the reasons, in addition to your years of experience with this business, why you've been so accurate. I want to thank you again, Michael, for being with us, and as always, I hope we can have you on again next week.
Great, Jay. I look forward to it. Thank you.